We're going to ruin our status as world's reserve currency. I think we're going to see a lot of deflation, because it's not just the Fed. It's not the Fed board members. It's probably one member, and that's Powell, who's insisting on unanimity. The Fed is a problem. I think they're making a mistake. I think the world is paying for it.
In today's video, ARK CEO, CIO Cathie Wood weighs in on Fed Chairman Jerome Powell, the impact of seasonal factors on economic indicators, why we believe we're moving into a deflationary environment. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation. Before listening to her, please ensure to smash the like button and subscribe to the channel.
We barely had whiteout, that's how primitive we were. But we were doing real research and a lot of critical thinking about how the world was going to work, what companies would do well in this new world. And we've gone from that, and the heyday of that was 80s and 90s. And then we had the tech and telecom crash and the 08-09 meltdown. And the world and our business has gone passive. If you go to some of these conferences, ETF conferences, for example, investors don't even really know what's in these ETFs, and they don't care. All they care is they're going to act a certain way in different kinds of market environments. So the art associated with active management, I think, has been lost in great measure because of these crises and risk aversion, career risk, business risk, and meeting and fulfilling an unmet need out there now. It's unbelievable what's happened in the last 20 years, how much research has disintegrated in our industry. And that is a real problem if we're talking about efficient allocation of capital. These benchmarks and indexes are all backwards looking. The biggest stocks and companies in those indexes are there because of past success. But if we're right, and we're going to see more disruptive, truly transformative innovation over the next 5 to 20 years than we have ever seen. It dwarfs even telephone, electricity, automobile. Those were 3 platforms at the same time. We have 5 brewing now, and they involve 14 different technologies, all of which are growing exponentially. So if we're right, then the traditional world order will be disrupted, and those indexes are not going to be a good place to invest. Now, what I'm fighting here is history, because as that 20-year phenomenon took place, it became a self-fulfilling prophecy. The more people investing in indexes, the better those indexes did.
Right. Okay.
So we've had our first breakthrough, though, with the FANGs. They're breaking down. And those were the biggest companies in most large cap benchmarks. They're breaking down because of disruption. TikTok is wreaking havoc. And so that's the first case in point. Watch out. Many people are dropping off. That means less interesting for many more users. So, we're probably looking at the negative network effect for Facebook. Instagram, it seems, is still fine, and WhatsApp as well. But Facebook is a huge part of the franchise. So, yes. Yeah. And then you asked about Netflix. They're getting into advertising, but it's not going to move the needle as much as people think. And yes, the competition is not just other streaming platforms. It's TikTok, anything that takes a consumer's time.
Yes.
And TikTok is addictive. I don't think it's going to be as mass market as any of their current products. I think it'll be interesting to see how they weave NFTs into the ecosystem. Yassine and I were speaking on the way over about artificial intelligence and how, with the creator community, AI is going to do some mind-blowing things. And NFTs and AI could be a beautiful match. Facebook's advanced in artificial intelligence, and but when you say Hail Mary, I would say this is going to take years for them. I think as the negative network effects associated with Facebook evolve, it will be very difficult for them to make that up with the metaverse. I think maybe in the next 5 years, maybe. Now, sometimes if you look at what happened during the bubble in the late 90s, sometimes the market's willing to look out 10 years, 20 years, and value stocks on the number of potential eyeballs they might have at some point around the world. That was the crazy 90s, and many companies were funded then that never should have been funded. Today, we're in the opposite environment. The time horizon is 1 quarter. They want their profits now, and they're very short-sighted. So it's a very difficult environment for our strategy, but innovation solves problems. We have many more problems. COVID was the launching pad for our strategy. We could do no wrong in 2020. Innovation solves problems. Then inflation and interest rates start moving up, and we can have a discussion about that. We might have a little bit of a different point of view, but our stocks were the biggest victim because of fears of inflation and interest rates. But again, these are the inflation and interest rates are causing more problems, and innovation does solve problems. And I think the growth rates, the exponential growth rates of our companies should overcome any fears about inflation and interest rates. It is the more mature growth companies, like the FANGs, that really need to fear this kind of environment. Nonetheless, with a 1 quarter time horizon and our PEs, in the stratosphere compared to others, even though we assume they're going to market like multiples within 5 years, we're terribly disadvantaged in a 1 quarter time horizon market, which is not what investing should be. And so we went from roughly 33 names to 58 names. There were IPOs, there were lots of exciting opportunities. And then starting February of 21 to our low in May, and we think that's the low, but we're getting close there again. You never know. The Fed, I do believe, is a big menace here. We were down 75%. Think about that. Up 360, down 75%.
I can't do the math on that. Where does that put you?
Where does it put it? If you've, let's see, someone just asked me the question saying, since inception, our strategy is up maybe a percentage point less than the S&P 500 or the NASDAQ, okay, which was single digits. But if you're telling me that after this bloodbath, I'm saying, oh my gosh, have we, this is a great setup for the future if we're just behind by that much, because we are so much more volatile than the benchmarks. And, there is going to be a change there too. When the shift away from benchmarks happens, we will be the self-fulfilling prophecy, or we will be the beneficiary of the self-fulfilling prophecy or self-fulfilling trend, which is away from benchmarks towards innovation, because it's going to become so obvious. So that 75% decline, why does that happen? It happens because most portfolio managers, even the active ones, so they really are trying to invest, they're still investing close to their benchmarks, and they don't want to be so far away from their benchmarks. Our stocks are not in benchmarks except for Tesla. And so Tesla, believe it or not, has held up better than most of our other stocks because it's in the benchmarks. When risk on happens, then they all start migrating and taking, positions in some of our names. And so that gives us the lift. Though the Fed is making a mistake here, and that, yes, high beta stocks, which would be our kinds of stocks, more volatile than the market, do get hit disproportionately. But something's happening now, and it's happening with Bitcoin as well, which I find very interesting. So our strategy bottomed intraday, the flagship, on May 12th. And And the S&P and NASDAQ have broken below their lows. Last week, they broke below their last lows. We did not. Now, maybe I'm jinxing myself, and we will now, but our strategy has held up better since May. And same with Bitcoin. Same with Bitcoin after the volatility in May. It's held in much better. It hasn't hit new lows, successive new lows. It's in a range, much like our strategy is. During a bear market and towards the end of a bear market, our strategy starts outperforming. Why? There's a saying in our business that the new leadership shows itself toward the end of a bear market. It starts outperforming. So at the end of 0809, for example, I was at a different firm, but our flagship strategy bottomed in relative terms, November 24th. I remember it well. And yet the market didn't bottom until March of 09. And in the first quarter, the market, as measured by the S&P, was down 10%. We were flat. And then we came out flying. And I'd like to think that's what's going to happen. The problem is the Fed here. And in the piece we wrote today, we said, please consider the conflicting evidence and at least debate. Talk about the risk of centralization. This is a massive risk because it's not just the Fed. It's not the Fed board members. It's probably one member, and that's Powell, who's insisting on unanimity in their fight against inflation. So what they're doing, what they've just done, is raised interest rates 13-fold from 0.25 on the Fed funds rate to 3.25, and they're going to go to 4, we believe, on November 2nd. That's a 16-fold increase in interest rates. Fixed income is more attractive than it was. It's also, there's a flight to safety to fixed income, to cash or bonds. So if you look at what he's doing, I think Chairman Powell thinks he's the reincarnation of Chairman Volcker. Now, I was early in my career during Chairman Volcker's reign, and he was fighting an inflation that really started with the Vietnam War in 1964, April, and then in May 64 was the Great Society, all of these social programs that President Johnson launched. That was the beginning of the inflation that Volcker inherited in 78 or 79. I think it was 79. 15 years, and it was embedded. There was cost push. People had gotten used to working around inflation, demanding certain wages and so forth. So that was 15 years. By the time the Fed recognized that it might have overstayed its welcome, it was maybe 15 months. That's a lot different. And this has been associated with supply shocks every step of the way. COVID, supply chain, Russian war. It's hard to separate out. And I think the key here, and this is where I'm going to have the biggest argument with the people who really think inflation, the genie's out of the bottle. I believe the velocity of money now is going to start falling again. It actually peaked in 97, has been falling. It falls at an accelerated rate during crises. And if the velocity of money starts falling now, that M2, it looks like M2 is going to come in below 3% year over year for September. If velocity is falling on top of that, that means nominal GDP growth is flat to negative on a year-over-year basis. That's a killer for companies' profits. Now, in this environment, the reason why we would start outperforming is because our fundamentals are better. We're the new world. Our revenue growth is much stronger than GDP. And in times of turmoil and trouble, again, innovation solves problems, revenue growth accelerates. Certainly that was the case in COVID. And I think the carnage of certainly in 2021 for us is, our strategy being dismissed by many old timers in the industry as, just a stay-at-home COVID strategy. All those stay-at-home stocks are now going to go into negative growth, which has not happened. So It's interesting. I think the Fed is a problem. I think they're making a mistake. I think the world is paying for it. If we think there's pressure here, the emerging markets, we're going to ruin our status as world's reserve currency and I remember there was a similar situation in the 80s, but we responded to it when the dollar was causing so many problems for the rest of the world. Treasury ministers from around the world got together in 1985. There was both the Plaza Accord and the Louvre Accord, and they agreed to sell dollars and buy back the other currencies to support those other currencies and to prevent the deflationary bust that was being caused by currency implosions in the emerging markets and their debt service exploding because it was dollar-denominated debt. The same thing's going on now. And I think we're going to see more rips in the fabric of the global financial system. I think what happened in the UK around pension funds was really more about banks. Those pension funds weren't going to meet those margin calls, and that was the banks were the counterparty, right? So they had to come in. So the BOE has already reversed its monetary policy. Now they say it's just till October 14th.
Well, they just extended again, didn't they?
Oh, did they?
Yeah.
Another week?
That.
Yeah. I think I might have heard that. Was it today?
They just announced today, yeah.
Yeah. So maybe another week or something. And so what's happening now? What are these pension funds selling so that they can be made a little more right, instead of upside down? They're selling the easiest financial instruments to sell: Treasury securities, government bonds. So that's one of the reasons we're seeing our government bonds back up. So we've got the BOE reversing. You've got the Bank of Japan and the Chinese Central Bank, PBOC. Both of them are supporting their currencies. What does that mean? It means they're selling dollars and buying their currencies. So it's freeing up some dollar liquidity, and there is a dearth of dollar liquidity out there. So I think we're going to see many other central banks doing that. But I also think when the ministers meet, the G20, in November, that the odds of another Plaza or Louvre Accord type agreement are going to be pretty high, because I think that we're seeing deflation in a lot of indicators now. Commodity prices, we're seeing inventories overwhelming retailers. So I think we're going to see a lot of deflation for cyclical reasons. And then secular reasons as well. Innovation is deflationary, but good deflation. It causes bad deflation for companies that are going to be disintermediated or disrupted or destroyed.